Welcome back to Turning Hard Times into Good Times. I'm your host, Jay Taylor. Is John with me now?
Hi, Jay.
Welcome, John. It's good to have you with us. Well, folks, John's been on with us several times before. He runs a very popular financial website called dollarcollapse.com, and he is the author, along with James Turk, of Gold Money, The Collapse of the Dollar and How to Profit from It. He's written and has been involved in writing various other books, too. He's a prolific writer. He writes for some established financial magazines, and John is really one of my favorite people, a really good friend of mine. So welcome, John. Really good to have you with me again.
Thanks for having me back, Jay.
Always good to talk to you. I don't know to what extent you heard any of David's remarks, but I have an idea that 99% of what David believes you believe as well to a great extent, but I really want to talk to you about, we've seen this soaring dollar now, and as I look at the screen, we're looking at an equity market, a Dow that's down over 200 points. The S&P has cut through 1947, which Art Cashin thought earlier today was a very crucial level, and if it did not hold, that we could be seeing a domino effect in the equity markets. We're certainly seeing some weakness in the equity markets. Now we've had this strong dollar, so-called strong dollar. The dollar has gained against most of the other currencies, specifically the euro and the yen, but the euro is the most heavily weighted foreign currency in the index, in the dollar index. And we're just talking about John Exter's inverted pyramid, and we see that what happens when the system starts to implode, when debt cannot be repaid, we start to see strength in the currency and in the treasury markets. Now, of course, this is a global economy, and other currencies are weaker, perhaps. But we do see the dollar going from, well, it was as low as about 70 in 2008. It's around 86 now. So that's, about a 23% rise in the value of the dollar vis-a-vis the other currencies in that basket in the index. So what are the factors, John? And maybe you could just sort of sum up the factors that are causing the dollar to gain vis-a-vis other currencies.
Well, the simple answer is that it's the dollar's turn in the currency war to be the strong currency. If you go back a few years, you see that the yen and the euro were relatively strong currencies. And look what's happening to their countries right now. Their strong currencies priced a lot of their exports out of the global markets, and now they're both dropping into recessions, which could be a lot more than recession for these guys. When an over-indebted society stops growing, its debt load becomes overwhelming. And that's what those guys are looking at now. They're looking at very possibly deflationary depressions if they don't actively liquefy the system. So they're going to their own versions of quantitative easing now, in their own way, because they have to. They have to flood the system with newly created currency. They have to force down the value of their currencies in order to survive. And so the dollar, because this is just all relative now, from one currency to another, there's nothing real in the foreign exchange markets right now. The dollar has to go up if the euro and the yen are going to go down. So it's basically the dollar's turn. We've had a relatively weak currency for the last few years, and our economy is doing relatively well compared to these other economies. But now with the dollar going up again, we're going to have the same problem that Europe and Japan have right now, which is that our multinationals are going to see a huge earnings hit because they sell stuff to the rest of the world, which means everything they sell that's priced in dollars is suddenly getting more and more expensive. And the euros and the yen that they're getting in return for the stuff they're selling are going down in value. So their earnings are going to drop and their margins are going to contract. And that's going to be a big problem for them, especially with the stock market being priced for perfection. So the stock market getting extremely volatile right now is a function of the dollar suddenly getting very strong, because all of a sudden it's introduced an element of uncertainty. Now we just don't know what's going to happen to these multinationals. And that's what's been driving the equity bull market for the last few years, the big blue chip stocks. So who knows now?
Yeah, it's, indeed. I mean, I think it was Art Cashin that said earlier today, I noticed he said that like 50% of the earnings of the S&P come from overseas, and so now there's a very strong headwind. And he's noticing that the analysts are really starting to pare back their projections for the next quarter's earnings. So that headwind that we're talking about, but again, John, the U.S. has done relatively well, as you say. I think, and as David and I discussed, and I think you're probably in agreement with, if you really looked at the real inflation rate, we may not be growing at all. We may be still contracting, even though we may have done relatively better than we did at the bottom. We're still not. Maybe we're contracting at a less rapid rate, but using the government's inflation numbers, it's showing a slight growth. But again, we get back to the notion, as David was saying in the first segment of this hour, that GDP, that debt to GDP in the United States is at enormously historical levels that have, that we've never seen before. We go back to 1934, I guess it was, or 32, at the bottom of the Depression. We got to something like 225%, but it's been over 313%, something like that now, where the average was something like 150% of debt to GDP. So if the U.S. is the strongest economy going, and the rest of the world is depending on us, now where it's our turn, as you say, to take the pain, to allow the others to try to stimulate themselves from getting into, from going over the cliff into this in deflationary implosion that John Exter warned us about, then the prospects don't look all that bright to me going forward.
No, and first of all, the debt to GDP numbers that are officially reported vastly understate the problem, because they don't include the unfunded liabilities for Social Security and Medicare, which are real debts. That's the health care for retiring baby boomers. Go ahead and try to take that away from us and see what happens. You can't just legislate that away. And it includes, or does not include, derivatives, which are clearly a form of debt. They're a liability. Sure. That are vastly understated on the balance sheets of the big banks. So you add those two together, and the debt to GDP number is surreal. It's something out of the Twilight Zone. And we cannot continue, and we're increasing that number year after year. So we can't continue down this path. Mm-hmm. And what's happening now is we're trading off. One country gets into trouble, and then they pump out a lot of new currency, and then the problem moves to another country, and it's sort of a game of musical chairs, in which at some point the music will stop and the worst run country, the most over-indebted country, will be left out. They will collapse and pull down the rest of the system with them. And we don't know when that'll be, but obviously that's what's coming.
Yeah, well, we started to see it happening with Greece. The United States went down 2008, 2009. I think the whole global economy almost got away from the from the landlords of the world, and they managed to stave it off. Who's to say they can't pull it off again?
Oh yeah. What they did was they staved off a deflationary depression in 2009 by borrowing a whole bunch of new money. So if debt was the problem back then, it's an even bigger problem now. But because this is completely uncharted territory, we've never had this much debt to deal with, and we've never had a world of central banks with unlimited printing presses before, and the willingness to use them in experimental ways. So we have no way of knowing, based on history, what the near-term future holds for us, because we've never been here before. But the long-term future is highly predictable, and that is that this debt will get away from us at some point, and things will spin out of control. But we can't know when, we can't know who's going to do it, who's going to be the first to go, and in what order the dominoes eventually fall. But there's no way we get out of this without huge pain. And what we've done in the last 5 years is double the amount of pain that we're going to have to deal with eventually by effectively doubling the amount of debt in the global financial system. So the dollar and generally foreign exchange rate movements right now are one of the tools that governments are using to try to delay the inevitable. And, you see from Europe and Japan right now that it could be that they're failing right this minute. It could be that they can't do it anymore, and that one of those systems will implode and take everything else down with them.
Yeah, it seems almost like we're struggling in quicksand. We have to issue more debt to stay alive, and the more debt we issue, the deeper we find ourselves mired in the quicksand. But you point out in an article that you wrote, and again, folks, you can read this if you go to John's website, dollarcollapse.com, that in fact that some people do benefit from a stronger dollar, for sure. I mean, our things should be somewhat less expensive And there's an argument made that seems to be probably sort of the cheerleaders on Wall Street are making, that this is actually going to help the stock market because all this money will be flowing into the United States and into treasuries and into the stock market. Well, there probably is some truth to that, but on balance, I take it you don't buy that.
Well, currency fluctuations are a mixed bag because they help you a little and they hurt you a little, no matter what the currency is doing. You know, if your currency is going down, that's good for your exporting industries because it makes the stuff that they're trying to sell to the rest of the world cheaper. So in that sense, it's a good thing. If your currency is going up, it makes the savings that you have accumulated more and more valuable. So that's a good thing. But currency fluctuations also hurt you. A strong currency hurts your export industries and makes your debt load even more and more onerous while it's making your savings more valuable. So you have to look at the national balance sheet. Do you have more debt than savings? And that's what tells you whether a rising currency is a good thing or not. And in our case, we have vastly more debt than savings. So a rising currency is on balance a really bad thing, just as it was for Europe and Japan. And it'll have the same effect on us. It's going to hurt our export industries, which will slow down the economy, and it's going to make debts harder for everybody to pay back, which will dramatically slow down the economy. And, you know, the relative handful of people who actually have savings in dollar bank accounts and stuff like that, their savings will get a little more valuable, but it won't come close to offsetting the damage that a 10 or a 15% more valuable dollar will cause. So give us another year, and we will be dropping into Europe or Japan style deflationary recession because we owe too much, and a strong currency does that to countries that owe too much. So you're seeing the immediate effects right now in the stock market. Volatility has totally spiked. Yeah. In the last 2 weeks. The average for the Dow right now, the average move is approaching 140 points a day, which is a really big move. That's kind of a notable move. They'll announce that on the financial news as the lead story if the market moves by that much. And we're getting it every day now on average. And today it's an even bigger move. I think you said 200 points, right?
Yeah, the Dow's down. Yeah.
And so what that means is that, in the money bubble, James Turk and I use an analogy of a spinning top for an over-indebted society that's getting ready to go. You know, you spin a top, and it spins really smoothly for a while, but then a wobble kind of sneaks into the motion. And the wobble gets bigger and bigger and bigger until the top just falls and flies off in a random direction. Well, that's what happens to an economy when it reaches a point where there's a phase change coming. And so this kind of volatility in the stock market is what it looks like when the system has been going in one direction for a long time, and now it's getting ready to go in another direction. We saw that in 2007. The stock market volatility went through the roof. You know, you had regular 200 or 300 point moves in the Dow. And we're getting to that point again here. So we don't know for sure if this is going to be it. You can only know that in retrospect. But this is what it will look like when the system starts to roll over and we start to enter a bear market.
We talked to David Jensen right before we spoke with you, and David made the point, which seems very logical, and I believe I'm in total agreement with him on that, and that is that gold, the distortion of the gold markets, plays a very vital role in enabling the interest rate markets to be distorted and manipulated by the policymakers. And David points out that by doing so, you have this horrible malinvestment. Not only are you creating huge amounts of debt as you try to stimulate this thing and drive interest rates lower, but you are channeling capital into areas of the economy that just absolutely don't produce anything. We can go back to the tech bubble in 2000, the housing bubble in the mid 2000s, and you see what happens with malinvestment, enormous amounts of malinvested capital. Do you share that notion that there's a connection between the suppression of the gold markets? First of all, if you agree that there is suppression of the gold markets, and secondly, if there is, that there would be a connection there.
Oh, absolutely. Gold, because it's real money. Historically, it's been real money for 3,000 years. Is a signal, when gold goes up, it's signaling that in a fiat currency system, monetary policy is too easy, that you've got extremely low interest rates and maybe negative interest rates. That's when gold starts going up. So if your public policy objective is to run a negative interest rate regime, in other words, have super easy money for a really long time, gold would stop you from doing that. and you have to suppress gold. You have to get in there and force its price down. Otherwise, everybody sees that as a signal, and they behave accordingly, and that short circuits your attempt to maintain extremely easy money for long periods of time. So yeah, governments since the 1960s have been manipulating the price of gold lower, and they've been periodically succeeding and periodically failing. You know, in the 1960s, they had the London Gold Pool, which was a secret system through which they depressed the price of gold. That failed when demand for gold went through the roof. And then we got the 1970s when we had a huge monetary crisis because we couldn't control gold's signaling, that interest rates were too low and monetary policy was too loose, and gold went to $800 and some an ounce. And we had to then raise interest rates to double digits for 5 years. You know, Paul Volcker raised the Fed funds rate to above 10% until 1985. So we're heading into a time when the imbalances, or actually we were in a time already, when the imbalances are vastly bigger than they were back in the 60s and 70s. So it's more imperative today for governments to short-circuit the gold price signaling mechanism now than it was back then. And they've been doing it with a vengeance. You know, they've been dumping thousands of tons of gold on the open market secretly over the last decade. Yeah. And a lot of that gold now is flowing east. You know, China and India and Russia are saying, oh, okay, you want to sell us artificially depressed gold. Cool, we'll take it.
Thank you very much, they're saying. And, of course, you know, David was making the point, yes, we've had, for sure, we've had these leases and other manners of letting gold out of the Western coffers into the markets and ultimately into Asia. But as David points out, we have this thing, what he refers to as essentially a virtual market where there's huge amounts of contracts that are entered into by a couple of very major institutions, only a couple of them that would have the wherewithal to enter in and smack down the gold price exactly at times when the market might start to say, I think I need some of that yellow metal as a protection, as some honest money. You know, we only have a couple of minutes to go here yet, but I just have to mention, or let you talk very briefly perhaps, there was a Raul Ilargi Mejir, I think, how do you pronounce his name, that you referred to in your write-up at dollarcollapse.com. He writes for something called the Automatic Earth. Can you just share his views, because they're rather cataclysmic, and can you just tell our listeners a little bit, if you could share what Raul had to say?
Yeah, the title of his article that I quoted was, U.S. dollar is about to inflict carnage all around the planet. And his take is that a rising dollar has a lot of negative effects around the world, and one of them is that it sucks the life out of the emerging markets. You know, they've been one of the few success stories in the global economy of the last 5 or 7 years. And now everybody wants to buy Japanese multinationals because they're the ones who are perceived to benefit from falling yen and a rising dollar. So all this hot money is flowing out of emerging markets and causing them to crash. And so in his take, that might be one of the catalysts for the next crisis, when we see Thailand and maybe India and China, you know, all these countries who were success stories all of a sudden start having huge amounts of trouble because the hot money is flowing out, whereas it flowed in just lately, and bid up a lot of asset prices there and made it look like their economies were more healthy than they really were. Yeah. So we should be watching the emerging markets, who are down dramatically today, by the way. You know, the U.S. stock market falling as the dollar goes up, it's very bad for them. So he says that that's the beginning of the next crisis.
Well, I must say that in reading Dr. Robert McHugh, his ominous warnings over the last couple of weeks that we are approaching something of a cataclysmic nature, or with a high probability that that's the case, is certainly nothing that we cheer. But what we try to do on this show is to ferret out reality. And thank you very much, John, for being with us, and along with David for helping us do that. And, of course, we want to go to real money, gold, money that cannot be destroyed by debt. It's nobody else's liability, so that's where we start, and we talk about constantly on this show. I do want to thank you, John, for being with us. We are out of time. We'll do it again sometime in the near future, hopefully.
Thanks, Jay. Enjoyed it.